It is Monday morning, July 27th, 2026. Pre-market. The opening bell hasn't run yet, but algorithmic systems have already completely wiped out billions in geopolitical risk premiums. The tape is flashing bright green across the board. S&P 500 futures are up 0.9%. The Nasdaq is surging 1.5%, and the Dow is pushing over 440 points higher overnight.
But look at the underlying flow, right? To actually dismantle what's happening across global trading floors right now, you have to isolate the primary macro catalyst. The epicenter of this morning's price action is strictly the energy market. We had that sudden weekend pause in U.S.-Iran military hostilities, and it is triggering an immediate violent repricing in spot crude. I mean, Brent crude just plunged over 6%, dropping toward $90 a barrel. West Texas Intermediate is falling nearly 5% toward 84.
Right, because last week the market was basically hoarding oil contracts as a geopolitical insurance policy. Portfolio managers were terrified that a event escalation in the Middle East would choke off the Strait of Hormuz. So what you're seeing with the 6% drop is just the instantaneous unwinding of that acute risk premium. Traders who bought upside calls on crude as a hedge, they're watching those options lose value, forcing market makers to aggressively unwind their underlying long positions.
The structural reality here is that institutional capital models view $100+ crude oil as a mathematical guarantee of sticky cost-push inflation. When energy prices stay elevated, that variable cost bleeds directly into global manufacturing, shipping, raw materials, which forces central banks to maintain restrictive monetary policy. A sudden 6% drop in oil removes that immediate inflationary overhang.
It creates a temporary vacuum of macro anxiety.
Exactly. Gives systematic funds the mathematical justification to bid up risk assets, like equities, before we hit the actual macroeconomic hurdles later this week. But you have to track the sector rotation. The drop in oil is completely rewriting the forward profit math for specific industries.
Let's trace that capital flight, starting with the losers on the tape. The briefing zeroes in on Occidental Petroleum, ticker OXY, which is down 3.8% in the pre-market. Upstream energy producers are taking the direct hit when spot crude collapses like this.
Their forward earnings models are hypersensitive to the price of a barrel. Because the diplomatic headlines temporarily wiped out the fear of supply disruptions, the speculative premium in Occidental's share price just evaporated overnight. The tactical levels outlined in the briefing are critical for anyone holding energy exposure today. Buyers have to aggressively defend and reclaim the $60 bull case level today.
Reclaiming 60 keeps the medium-term uptrend intact, basically preserving the technical structure, just in case diplomatic talks break down and those shipping delays reemerge. But the downside risk is severe here. If Occidental loses the $56 bear case support, the technical structure breaks completely.
That's completely erased if we break 56, yes. You are looking at a potential free fall, creating a secondary floor all the way down at $50 as momentum algorithms jump in to short the weakness. The capital fleeing that energy sector, though, it's finding an immediate home in travel and leisure.
Right. We have American Airlines up 3% and Delta Airlines up 2.6% in the early tape. Jet fuel is obviously the single largest variable cost for the airline industry, often up to 30% of operating expenses. So a sudden 6% drop in crude instantaneously expands their projected free cash flow just as we head into late summer travel data.
But look at the specific technical setup for Delta today. Breaking and holding above $86 validates this cash flow expansion thesis, opening a clear technical runway toward its 52-week high around 95. But if it drops below pre-market support at 82, that signals the broader market is rejecting the thesis. It means institutional algorithms are pricing crude oil risks right back into the tape.
Wait, if these diplomatic headlines are just a temporary weekend pause, aren't these travel stocks trading on a complete mirage? I mean, if strikes resume tomorrow or even later this week, doesn't this entire free cash flow expansion thesis collapse instantly?
It absolutely collapses, which is why institutional desks are treating this specific sector rotation as highly tactical, fast money flow, not a permanent structural shift in airline fundamentals. Capital rushing into American and Delta this morning is just seeking immediate beta. They are trading the headline momentum, fully prepared to dump those positions the millisecond a negative headline hits the terminal.
Not all the capital movement today is purely macro-driven, though. We do have AstraZeneca up over 1% pre-market on a solid Q2 earnings beat, fueled heavily by surging sales in its oncology division. So fundamental stock picking is still functioning under the surface.
It is, but rotating out of Occidental and into Delta mathematically does not account for a 1.5% surge in the entire Nasdaq 100. For a move of that magnitude, there has to be a deeper structural bid under the market. And the briefing attributes this massive tech surge to the macro plumbing.
Right, the capital flowing aggressively into semiconductors and mega cap tech today.
Macro plumbing refers to the underlying structural dynamics that dictate how and where massive pools of capital flow, specifically the interplay between bond yields, currency valuations, and algorithmic trend-following systems. Today, all three of those structural pipes are pointing directly into big tech. It's operating as a massive tailwind ahead of the mega cap hyperscaler earnings later this week.
Let's look at the primary beneficiary of that flow, which is NVDA. It is trading up 1 to 1.3% in the pre-market, hovering in that $206 to $208 range on tremendous volume. They have a massive weekend catalyst driving this. Headlines detailing a $500 billion AI infrastructure deal with SK Group, alongside reports of expedited TSMC Arizona shipments.
A $500 billion infrastructure build-out fundamentally alters the forward guidance models for the entire semiconductor supply chain. It provides institutions with the tangible long-term revenue visibility they need to justify current valuations. The tactical levels for NVIDIA demand attention today. A clean, high-volume breakout above 214 signals institutional accumulation, setting the stage for a pushback toward all-time highs at 236.50.
Conversely, losing intraday support at 204 triggers an algorithmic technical pullback, plunging the stock down to a heavily defended 195 demand zone. But that structural bid under NVIDIA is being massively amplified by the bond market today. The 10-year Treasury yield is down 4 to 5 basis points this morning, sitting at 4.63 to 4.65%. That's pulling back from an 18-month high of 4.71% last week.
The easing energy prices we discussed earlier took the immediate pressure off inflation expectations, allowing Treasury yields to drift lower overnight. A 4 to 5 basis point drop in the 10-year yield fundamentally alters the valuation math for mega-cap tech.
Right. I always conceptualize the 10-year yield as the market's financial gravity. Higher yields exert a crushing gravitational pull on long-duration assets, pulling valuations down. When yields drop, that financial gravity weakens, allowing high-growth, high-multiple stocks to jump higher.
When the risk-free rate drops, the mathematical penalty applied to a tech company's future cash flows lessens, inherently making those future earnings worth more today. That weakened gravity mathematically forces systematic funds to rebalance their portfolios, allocating more weight to high-beta tech equities.
We also have the dollar index, the DXY, slipping this morning, hovering between 101.13 and 101.26. A softer dollar provides a massive, albeit temporary, foreign exchange boost for multinational tech companies.
Alphabet, Tesla, Meta, they all generate massive revenue overseas. When the dollar weakens just days before they report earnings, that overseas revenue converts back into more U.S. dollars, artificially padding their quarterly results.
So the macroeconomic backdrop is providing a perfect, frictionless environment for a tech rally. Oil is down, yields are easing, the dollar is softening, and we have a $500 billion AI catalyst hitting the tape. Which brings us to the most jarring part of this entire pre-market briefing. With the board flashing bright green and structural tailwinds aligning perfectly for tech, the institutional desk explicitly warns clients, in bold lettering, not to chase this rally.
They are diagnosing this entire Monday morning regime as a liquidity trap.
The early strength across the major indices is a byproduct of headline relief and fast money rotation, not sustained, structural institutional buying.
Exactly. Pushing capital into heavily defended overhead resistance zones right before a hawkish Federal Reserve meeting on Wednesday and right before the mega-cap tech earnings reveal their actual forward guidance is an incredibly dangerous asymmetrical risk.
But if institutional desks are explicitly warning their clients about a bull trap today, who exactly is providing the massive buying pressure to push the Nasdaq up 1.5% right now?
The buying pressure is largely a combination of algorithmic systems reacting blindly to the crude oil drop and retail capital caught in what the briefing calls the pain trade. Retail investors have been heavily conditioned over the last decade to indiscriminately buy tech dips, operating under the assumption that the Federal Reserve will eventually step in and cut rates to support the market.
That conditioning is colliding with a very hostile macroeconomic reality. The Fed is currently expected to hold rates steady at 3.50 to 3.75% on Wednesday. But the futures market is actually pricing in a 30% probability of another rate hike if inflation shows any sign of flaring back up.
The bond market is telling a completely different story than retail flow. The pain trade revolves around the catastrophic consequences of sticky, cost-push inflation returning to the data. If energy spikes again or global supply chains tighten further, the narrative of Federal Reserve rate cuts is completely destroyed. If Powell delivers a hawkish shock on Wednesday, the 10-year yield will instantly reverse, spiking past 4.70% and accelerating toward 5.00%.
Financial gravity suddenly turns up to 10, crushing the valuations of everything in its path.
A 5% risk-free yield triggers immediate, brutal multiple compression across the entire technology sector. In a multiple compression event, a tech company can report stellar earnings, perfectly match forward guidance, execute flawlessly, and its stock price will still crater. Institutional portfolio managers will refuse to pay a 40 or 50 times forward earnings multiple for the inherent risk of an equity when they can secure a guaranteed zero-risk 5% yield by simply parking billions in short-term treasuries.
Capital abandons the tech dip entirely and flees straight into cash. The late entry retail buyers who chased the morning headline relief, assuming the decade-old dip buying strategy was still valid, they're left holding severely overvalued tech stocks as institutional liquidity just vanishes. That is the trapdoors snapping shut. Let's map out exactly where those trapdoors are located on the charts today. The briefing gives strict tactical lines in the sand for today's session. For the S&P 500 futures, major overhead resistance is sitting at 7,520 to 7,540.
That 7,520 to 7,540 band is a top-of-range supply zone, and it is heavily defended by institutional sellers. Bulls require a high-volume daily close above 7,540 just to invalidate the recent downward trend structure.
The intraday pivot for the S&P is 7,480. Expect choppy, two-way algorithmic scalp action around that line. The critical downside support is 7,420 to 7,440. A clean, decisive breakdown below 7,420 triggers systematic trend-following algorithms to start selling, pushing the index down to 7,380. Now, for the Nasdaq 100, the resistance is 25,850 to 25,950.
Pushing the Nasdaq up into that 25,850 zone means colliding with a massive wall of moving average supply. It is the origin point of previous institutional breakdowns. If the Nasdaq tests that level today and gets fiercely rejected, it confirms a tactical bear flag pattern on the daily chart.
The Nasdaq pivot is 25,500, but the absolute critical downside support is the 25,000 to 25,100 zone. The briefing notes that losing 25,000 triggers broad degrossing across the market.
The real risk here is the mechanics of that degrossing. It is a forced mechanical action taken by quantitative funds and commodity trading advisors, or CTAs. These algorithmic funds manage massive pools of capital based strictly on momentum and volatility triggers, not underlying company fundamentals. When a critical technical level like 25,000 on the Nasdaq is breached, it trips their automated risk limits.
So to flatten their market exposure and protect capital, these funds are programmed to simultaneously dump their long positions and aggressively buy back their short positions.
They are unwinding their entire book indiscriminately. It creates a cascading liquidity vacuum. The algorithms dump semiconductor and mega-cap tech exposure regardless of how strong a company's individual earnings might be. When multiple massive funds degrow simultaneously, it overwhelms the market makers, causing sudden sharp spikes in volatility that accelerate the downward momentum.
The ultimate takeaway for you navigating this morning's incredibly complex tape is to respect the structural reality beneath the headlines. Stay exceptionally light on leverage. Respect the tactical lines in the sand, the 7,520 resistance on the S&P, and the critical 25,000 support level on the Nasdaq. Keep your position sizes tight today because range-bound liquidity traps are going to dominate the price action until the Federal Reserve's rate announcement and the incoming big tech results establish the actual structural direction of the market later this week.
Consider the sheer velocity of the information we processed today. A diplomatic headline drops over the weekend, and before the sun even rises on Monday, algorithmic systems have fundamentally rewritten the forward profit map for global airlines, energy conglomerates, and the semiconductor supply chain. When you look at the massive pre-market gaps on your screens this morning, you have to critically evaluate your own positioning. Are you deploying capital based on the long-term economic reality of a geopolitical event, or are you simply getting caught in the crossfire of machines programmed to buy and sell headlines in milliseconds?
Watch your position sizing, respect the financial gravity of the bond market, and monitor the overnight flow into Wednesday's Fed decision.